Okay, so you've decided to sell your business. You've spent years building it, maybe a decade, maybe two. And now the number in your head, the one you've been quietly protecting for years, is finally about to become real. Someone is going to write you a check. You're going to hand over the keys. You're going to walk away with enough to retire comfortably, or start something new, or finally stop lying awake on Sunday night thinking about payroll. That's the plan. Here's what the plan is missing. The average small business owner sells their business exactly once in their life. Once, the buyer sitting across the table from you has done this dozens of times. Their attorney has done it hundreds of times. And the gap between what you think your business is worth and what a buyer will actually pay, combined with the gap between the number on the purchase agreement and the number that lands in your bank account after taxes, fees, and deal structure. Those two gaps together can quietly cost you more than you earned in the last 3 years of running the business. This is not a story about bad luck or predatory buyers. It is a story about structure, about the mechanics of how a business sale actually works, what gets extracted before you see a dollar, and the decisions made years before the sale that determine whether you walk away with real financial freedom or a fraction of what you deserved. By the end of this, you will understand exactly why the most expensive mistakes in a business exit are made long before you ever sit down at the closing table. Before we talk about what your business is worth, we need to talk about what kind of sale you're actually doing, because that phrase, selling a business, covers an enormous range of completely different transactions with completely different economics, and most owners never stop to ask which one they are actually in. There are roughly 5 exit paths most small business owners end up on, whether they planned it deliberately or drifted into it. The first is a strategic sale. You sell to a competitor, a supplier, or a larger company in your industry that wants what you have built. They are not buying your revenue. They are buying your customer relationships, your market position, your team, or your footprint in a geography they want to enter. Strategic buyers often pay the highest prices in any given market because your business is worth more operating inside their structure than it is standing alone. A regional accounting firm that acquires a smaller practice to add a specialty service, a national distributor buying a local competitor to eliminate them, a private healthcare operator acquiring a solo practice for the patient list. These are strategic sales, and they are the most financially favorable scenario for most sellers if they can get there. The second is a financial sale. You sell to a private equity group, a search fund operator, or an individual professional buyer whose primary interest is the cash the business generates and nothing else. These buyers are disciplined, experienced, and focused almost entirely on one metric: the return they will earn on their invested capital. They will pay what the math supports. They will not pay more because you have an emotional connection to what you built, and they will find every reason to pay less if the numbers give them a justification. A private equity buyer looking at a small business runs a model before they ever meet the seller. They determine what purchase price, at what multiple, will deliver the return their fund requires, typically somewhere between 20 and 30% annually over a 3 to 5 year hold. That math produces a maximum price they will pay. Everything above that number is a price at which the deal does not work for them, regardless of how much they like the business or how compelling the story sounds. The third is an internal sale, sometimes called a management buyout. Your own management team purchases the business from you, often using seller financing, which means you become the bank. You receive payments over time, rather than a lump sum at closing, and you carry the ongoing risk that the business performs after you are no longer there to run it. This structure can work exceptionally well when the team is capable, the transition plan is genuine, and the financing terms are carefully structured in writing. It frequently ends in disputes when none of those 3 conditions are true. The fourth is a family transfer. The business passes to a son, a daughter, or another relative. This is the most emotionally complex transaction in all of business, and frequently the most financially damaging to the seller. Fair market value and family loyalty do not naturally coexist. Sellers routinely accept below-market terms they would refuse from a stranger. They carry the anxiety of watching someone they love navigate a business they understand better than anyone, and they frequently end up informally advising the new owner for years after the sale, without the compensation the consulting would have earned from anyone else. The fifth is a distressed sale. The business is sold quickly at whatever price the market will bear, because the owner needs out. Health, burnout, a partner dispute, a business in decline. Buyers in a distressed scenario have all the leverage and no urgency. They will take their time, they will find every deficiency, and they will price it accordingly. This script is going to focus on the strategic and financial sale, the 2 most common exits for owners who built something real and want to monetize it on their own terms. But the financial mechanics we are about to walk through apply in some form to all 5. Now here's the number that defines everything else in this process, and most owners misunderstand it the first time they hear it. Your business is not worth what you put into it. It is not worth what it would cost to build it from scratch today. It is not worth what it means to you personally after a decade of your life. It is worth exactly what a buyer will pay for it today. And that figure is calculated almost entirely on one variable: how much cash the business reliably produces. The methodology buyers use is called a multiple of EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. In plain English, it is how much cash the business generates from its operations before financing decisions and accounting adjustments are layered on top. For a small business, a closely related figure called seller's discretionary earnings, or SDE, is even more commonly used. SDE starts with EBITDA and adds back the owner's total compensation, salary, benefits, personal vehicle, health insurance, and any other personal expenses run through the company on the logic that a new owner would either pay themselves that amount or redirect it as profit. The multiple applied to those earnings depends on several variables, and understanding exactly which variables move the multiple is the most financially important thing a business owner approaching an exit can know. Here is what the actual market looks like. According to BizBuySell's 2024 Insight Report, which tracks tens of thousands of completed small business transactions across the United States, the median sale price for a small business was 2.4 times annual SDE. Businesses below $1 million in SDE typically transact in a range of 2 to 3 times earnings. Businesses generating between 1 and 5 million in EBITDA move into a 3 to 5 times range and begin attracting more sophisticated buyers who compete against each other. Businesses above 5 million in earnings start drawing institutional capital from private equity and family offices and can command 5 to 8 times or higher in competitive processes. Let's slow down and actually run the math on what those multiples mean at a specific business size. A business generating $400,000 in SDE, which is a comfortable personal income for the owner, sells at the median multiple of 2.5 times. That is a purchase price of $1 million. After transaction costs and taxes, which we are going to walk through in detail, the owner might net somewhere between $640,000 and $730,000. If that owner worked 60-hour weeks for 10 years to build that business, and a very large proportion of small business owners do exactly that, the implied return on a decade of their working life is a number most people would find genuinely uncomfortable once they sit down and calculate it. Now take the same business. Same $400,000 in SDE, same industry, same location. But this version has documented operating systems and procedures that allow the business to function without the owner's daily presence. It has a management team handling operations. Revenue is distributed across 40 customers, with no single client accounting for more than 12% of total annual sales. And the business shows 3 consecutive years of consistent, modest growth in both revenue and earnings. That business commands 3.5 to 4 times earnings. The purchase price rises to $1.4 to $1.6 million. Same underlying cash flow, completely different story, completely different price. This is the structural truth that almost no one tells a small business owner clearly enough. The multiple is not given to you. It is built. And the decisions that determine your multiple are made years before any buyer ever sees your financials. Now here's what buyers are specifically using to justify paying a higher multiple, because this is the exact framework that will determine the price you are offered. Customer concentration is the single factor that kills more multiples than any other. A business where 2 customers represent 60% of revenue is not valued on $400,000 of SDE. It is valued on what $400,000 of SDE becomes if either of those customers leaves, which is approximately $160,000. Buyers price the risk of customer concentration explicitly and aggressively. Every percentage point of revenue sitting inside a single customer relationship is a percentage point of risk that reduces the multiple they will offer. In practice, most buyers draw a hard line at 20%. A single customer representing more than 20% of annual revenue is a flag that triggers a formal discount to the multiple. A customer above 30% is a structural problem that some buyers will not get past at all, regardless of how strong everything else looks. The math behind this is straightforward. If that customer leaves 6 months after the sale, the buyer just paid a significant multiple for earnings that no longer exist. The discount they apply is their protection against that outcome. Reducing concentration before a sale is not merely cosmetic. It is the single most financially productive thing most owners can do in the years before an exit. Management depth is the second driver. A buyer is not purchasing a job for themselves. They are purchasing a system that generates cash with or without the original owner. A business that requires the current owner to be present and involved in key decisions to function is a dependency, not a business. Buyers call this owner reliance, and they will discount a price substantially to compensate for the transition risk it represents. Recurring revenue is the third. A business with contracted or subscription-based revenue that renews automatically is fundamentally more predictable than one that re-earns its customers month to month. Predictability is worth real money in any valuation. A meaningful shift in the percentage of revenue that is recurring or under multi-year contract can add a full turn to the multiple a buyer will justify. The owner who understands these three variables and actively improves them over 2 to 3 years before a sale is operating in a completely different financial position than the owner who starts thinking about exit when they are ready to be done. Now here's where the mental model almost every seller starts with falls apart. Most owners picture selling their business as receiving a purchase price and depositing it. The purchase price is the opening number. It is never the closing number. The first deduction is the business broker or M&A advisor fee. For businesses under $1 million in total value, a broker typically charges a success fee of 10 to 12% of the transaction, taken from proceeds at closing before the seller receives anything. For businesses between $1 million and $5 million in value, that fee ranges from 8 to 10%. On a $1 million sale, the broker fee alone is $80,000 to $120,000 out the door before the seller has touched a single dollar. The second deduction is legal fees. A business sale requires a purchase agreement, representations and warranties from the seller, schedules of all assets and liabilities, employment agreements for key staff being retained, and typically a non-compete agreement from the seller covering several years and a defined geographic area. A qualified transaction attorney on the sell side charges between $15,000 and $50,000 for a clean and straightforward deal. If due diligence surfaces complications, or if the parties dispute indemnification terms or post-closing adjustment mechanisms, legal costs climb significantly higher. The third deduction is the working capital adjustment, and this is the one almost no seller sees coming. When a buyer purchases a business, they expect to receive it with a normalized level of working capital already inside the business. Enough cash, receivables, and inventory to keep operations running from day one without any additional capital injection from the buyer. The definition of what constitutes a normalized level is negotiated between the parties and written into the purchase agreement. Then, 60 to 90 days after closing, the actual working capital delivered at closing is calculated and compared to the agreed target. If the business delivered less than agreed, the seller writes a check back to the buyer after the deal has already closed and the champagne has already been opened. According to research from Duff and Phelps, working capital disputes are among the most frequently litigated issues in small business M&A transactions. Most sellers encounter this clause for the first time after they are already bound by it. The fourth deduction is escrow. Most buyers require 10 to 15% of the purchase price to be held in a third-party escrow account for 12 to 18 months after closing. This is the buyer's protection against the seller's representations in the purchase agreement turning out to be inaccurate. If the seller represented that there were no pending lawsuits and one surfaces 4 months after closing, the buyer makes a claim against escrow. If no valid claims are filed within the escrow window, the funds are released to the seller. But for the year or more following the day you sold your business, a significant slice of your proceeds sits in an account you cannot access. The fifth deduction is the one that hits hardest and surprises sellers most: taxes. How a business sale is taxed depends entirely on how the transaction is structured, and the difference between a well-structured deal and a poorly structured one can be worth 6 figures to the same seller on the same transaction. There are 2 primary tax structures for a small business sale: an asset sale, where the buyer purchases the individual assets, equipment, customer relationships, intellectual property, and goodwill, and a stock sale, where the buyer purchases the ownership equity of the entity itself. Buyers almost always prefer asset sales. They receive a stepped-up tax basis on the assets, allowing them to depreciate those assets over time and reduce their future tax liability. Sellers almost always prefer stock sales because the proceeds are typically taxed at long-term capital gains. Rates, which max out at 20% federally plus the 3.8% net investment income tax for higher earners. In an asset sale, the tax treatment is more complicated. Proceeds allocated to goodwill qualify for capital gains rates, but proceeds allocated to non-compete agreements signed by the seller are taxed as ordinary income at rates that can reach 37% federally before state taxes are added. A business that sells for $1.5 million in an asset sale, with $400,000 of the purchase price allocated to a 3-year non-compete agreement, is generating nearly $500,000 of ordinary income for the seller, spread across 3 years of payments. The seller who modeled their net proceeds assuming everything qualified for capital gains treatment will encounter a very different number when the tax return is prepared the following April. This is why deal structure is not a legal formality left to attorneys after the price is agreed. It is a financial decision worth careful analysis with a CPA experienced specifically in business transactions, and that analysis needs to happen before the letter of intent is signed, not after. Now, here is the trap that catches even experienced sellers more often than it should. An earnout is a portion of the purchase price, paid after closing, contingent on the business hitting specific performance targets under new ownership. Revenue thresholds, EBITDA milestones, customer retention rates. The seller accepts deferred future payments that depend entirely on how the business performs once someone else is making all the decisions. Earnouts appear in deals where the buyer and seller cannot agree on value. The buyer will pay $1.2 million today. The seller believes the business is worth $1.8 million based on the trajectory it was on. The compromise is $1.2 million at closing with up to $600,000 in earnout payments over 2 years if specified targets are hit. It sounds like a fair resolution. Here's why it frequently is not. Once the sale closes, you no longer control the decisions that determine whether those targets are reached. The buyer does. They may change the pricing strategy, reorganize the sales team, deprioritize the customer segment that was driving your growth. Merge your operation into a larger entity in ways that make your original metrics impossible to measure cleanly. They may simply run the business differently than you did, and the targets fall short through no one's fault, which still means the payments do not arrive. According to SRS Acquium, which tracks outcomes across thousands of completed M&A transactions, only 40 to 50% of earnout provisions are fully paid to sellers. The rest are partially received, disputed, or lost entirely after a legal process the seller did not plan for emotionally or financially. An earnout is not a guaranteed future payment. It is a bet on a business you no longer run, measured against targets you no longer control, collected through a dispute process you hope never to need. When earnout disputes do arise, they are expensive and demoralizing. The seller believes the targets were not met because the buyer made decisions that prevented them from being met. The buyer believes the targets were not met because the business did not perform as the seller represented it would. Both sides have attorneys. The process takes months. The legal costs often exceed the disputed amount at the lower end of earnout ranges. Sellers who insist on earnout provisions despite this track record are usually doing so because they have no better option. A seller who negotiated a competitive process and received multiple offers rarely needs an earnout at all. The earnout is frequently a symptom of a sale that lacked competitive tension from the start. To understand what happens to a seller who enters this process unprepared, consider the pattern that plays out continuously across the lower middle market. A business owner receives an unsolicited approach. A larger competitor or a private equity-backed roll-up actively acquiring businesses in the sector makes contact. The interest is flattering. The buyer sounds credible. The owner, who has never been through a business sale before, signs a letter of intent within a few weeks, excited by the attention and the offer without fully understanding what they have agreed to. A letter of intent is non-binding in most respects, but it contains 2 provisions that are entirely binding. The first is exclusivity, which prevents the seller from speaking with any other potential buyers for 60 to 90 days while the buyer conducts due diligence. The second is confidentiality, governing what can be disclosed during the process and to whom. The moment those 2 clauses are signed, the seller has handed the buyer an enormous structural advantage. The buyer can take their time, they have no competition, and if they find anything during due diligence to justify a lower offer, they know the seller has no place to go. Due diligence begins. The buyer sends a request list, 5 years of tax returns and financial statements, customer contracts, lease agreements, employment agreements, insurance policies, any pending or threatened legal matters. Intellectual property documentation. The seller scrambles to assemble documents never gathered in one place. Issues emerge. Revenue was more concentrated in 2 customers than the summary financials suggested. The building lease has a change of control clause requiring landlord approval to transfer, which the seller was not aware of. A piece of equipment listed as an asset carries deferred maintenance the buyer treats as an immediate capital requirement. Each issue becomes a negotiating point. The original offer was $1.5 million. After due diligence, the buyer submits a revised offer at $1.2 million, citing customer concentration risk, the lease complication, and the equipment liability. The seller, now 80 days into exclusivity with no other buyers available, exhausted from months of document production and internal anxiety, with employees starting to sense that something significant is happening, accepts the reduced offer. $300,000 left on the table. Not because the business was worth less, because the process was entered without preparation, without a competitive dynamic, and without someone on the sell side who had navigated this sequence before. Here is what experienced advisors understand, and most sellers discover only after it is too late to matter. Your business does not have a single fixed value. It has a range of values. The difference between the low end and the high end of that range is determined almost entirely by how many qualified buyers are competing for the same opportunity at the same moment. A buyer who believes they are the only interested party has no urgency and faces no competition. They can run a long process, make a conservative offer, and negotiate every concession the seller will accept, because the seller has no alternative. A buyer who knows 3 other credible bidders have submitted competing letters of intent by the same deadline behaves entirely differently. Not because the business changed, because the dynamic changed. Experienced advisors run what is called a controlled auction process. A curated list of potential strategic and financial buyers is contacted simultaneously. Interest is collected within a defined window. All letters of intent are due on the same date. The seller reviews competing offers from a position of genuine leverage rather than quiet desperation. According to Axial, a platform connecting business sellers with institutional buyers, businesses sold through a structured competitive process command premiums of 20 to 40% above businesses sold to the first party that expressed interest. On a $1.5 million transaction, that premium is $300,000 to $600,000. More than the advisor fee most sellers try to avoid by handling the process themselves. Now, let's put all of this together and look at what a real sale actually looks like at both ends of the outcome range. In the optimistic scenario, the owner began preparing 3 years before the intended sale date. Customer concentration was actively reduced, so no single client represented more than 15% of total revenue. Operating procedures were documented in enough detail that the business continued running normally during a 2-week period when the owner was completely unavailable. A manager was developed to handle day-to-day decisions without escalating everything upward. Books were clean and consistent, so 3 years of tax returns aligned with 3 years of financial statements without requiring a page of explanation. When a competitive process was run through an experienced advisor, 4 buyers submitted letters of intent. The strongest offer came in at 3.8 times SDE, at $500,000 in SDE, that is $1.9 million. After broker fees, legal costs, and a deal structured primarily to qualify for capital gains treatment, the seller nets approximately $1.3 million. In the realistic scenario, the owner decided to sell when they were burned out and emotionally done. The books were complicated because personal expenses had run through the business for several years. 2 clients represented 57% of total revenue. The owner was embedded personally in every key customer relationship and had not been fully away from the business for more than a few consecutive days and years. A single buyer ran due diligence, found all of it, and submitted an offer at 2.1 times SDE. At $500,000 in SDE, that is $105 million. After fees and a deal structure carrying meaningful ordinary income tax exposure, the seller nets somewhere between $670,000 and $730,000. The gap between those two outcomes is over $600,000. It comes from the same business, the same revenue, the same industry. Every dollar of that difference was determined by decisions made 2 to 4 years before the sale, not on the day the papers were signed. The mistake most small business owners make is treating the exit as something to figure out when they are finally ready. A finish line they will sprint toward when the moment arrives. It is not the finish line. It is the exam. And the preparation for the exam is the decade of choices about your customer base, your management team, your operating systems, and your financial records that came before it. The buyers across the table do this every day. They know what a transfer-ready business looks like. They know exactly what an owner-dependent, customer-concentrated business is worth once due diligence is complete. And they know precisely how to use a 90-day exclusivity window to move a price from where you started to where they want to finish. The sellers who walk away with what their business genuinely deserves are not the ones who found a generous buyer. They are the ones who spent years making their business easier to buy, harder to discount, and worth fighting over at a table with more than one person sitting on the other side of it. Your business is likely the single largest financial asset you will ever build. The exit deserves the same preparation, the same rigor, the same discipline, and the same intentionality that built it. Because the number in your account when it is all over was not decided at the closing table. It was decided long before you ever got there. And that is true whether you know it yet or not.